What is going on, ladies and gentlemen? In this video, I'm going to be identifying and how to go over draw on liquidity. Now, it's a little different than daily bias, so if you want to find out what the difference is, stay tuned till the end of the video. Let's get right into it. So, draw on liquidity is different than daily bias for one main reason. Daily bias is usually the bias you're going to have for almost the whole day. Now, when you're looking for daily bias, you're using probably the daily candle, probably the 4 hour, probably the 1 hour, etc. But for drawing liquidity, time is fractal and you can use any time frame you want. And because I trade the 1 minute time frame, I'm really only looking for like 15-minute draws on liquidity. Once in a while, hourly draw on liquidity, etc. Now, there's two main areas where I'm looking for the draw on liquidity to be: equal highs and equal lows, and intermediate term highs and intermediate term lows. I also have my one setup for life, and that's a completely different draw on liquidity, DataWix. If you're interested in learning about that, just type in my YouTube name and then one setup for life. And combining equal highs and equal lows and intermediate term highs and intermediate term lows, I'm actually looking for market maker models to tell me whether these are going to be a draw on liquidity or not. Okay, so let's show you an example. So in this past current week, we've actually had a draw on liquidity, these equal highs, for a while now. Okay, and what happened was we failed to hit these highs here. Okay, this was back in the beginning of September, and because of that, we have to now wait for us to go into a buy model to determine that these are going to be the draw on liquidity. So what do? Well, you obviously wait for the downtrend to complete or reverse, and you really want to look for a solid market structure shift, and there's really never a market structure shift here, and there was really no market structure shifts here. The first market structure I kind of see here is, I would say, this one right here. So we kind of come down, create a low. We also break this bearish fair value gap, and that is a strong indication of us going back into a buy model. And now, once we're back on the buy side of the curve, which if you don't understand we're on the buy side of the curve here, well, you should at least understand by here. Now that we're on the buy side of the curve, where would the draw on liquidity be? Well, it's going to be towards those smooth highs, okay? And you can see a little choppy before we hit them, but we eventually got them, and it was a really actually nice Asia trade that I caught that I alerted on my Discord. So again, when we fail to hit them here, we have to wait for us to go back on the buy side of the curve, and then we know that equal highs are going to be a good draw on liquidity, because this is one of those 4 levels where I usually love to look for them as draw on liquidity. And it was actually also an intermediate term high. You can see this high rejected this fair value gap on the way down. Now, let me explain why that also was a good draw on liquidity. Before we start the buy side of the curve, there is a high that comes into fair value gap and rejects it, okay? And honestly, you could probably combine these two. But what causes price to go down here off of fair value gap? Well, obviously algorithm selling, right? Selling causes that. So if algorithms are selling at this fair value gap, where are their stop losses naturally going to go? Well, they're going to go above that high that we rejected the fair value gap in. So I know when we go down and down and down, and then all of a sudden reverse, I know that when we go back up, this is going to be a great target because it's where people shorted to cause price to go down. So that's why it's the other really good draw on liquidity. So let me just show you guys a few more examples of this. So another example is actually right here. So we get an inversion set up, whatever. It's a general kind of, this isn't really valid for my particular model, but we get a general inversion set up. It tells us we're likely to reverse. And on the sell side of the curve, when price went down, we had a high here that rejected this fair value gap, and we also had a high here that rejected this fair value gap as well. So I know these highs are going to be important, but not yet. Only after we reverse and after we kind of take out another low, so right here, and only after we get an inversion to indicate that we're now on the buy side of the curve. So we got that inversion, and then these will now be your 2 targets for the draw on liquidity, because we're on the buy side of the curve. And where do people short? Well, they're shorting in here and they're shorting here. And now that we've taken out sell side liquidity, is there any need to reject this fair value gap? No, not at all. So where are you going to naturally target? The place where people shorted on the sell side of the curve. So here and here. You can see it would have worked out very nicely. Same thing in this situation here. We sweep these kind of relative equal highs, Now, in live time, I don't know what's going to happen here, but in live time, I see, oh, there's no displacement, and we also broke these two bullish gaps. And when I see that, I'm already thinking, okay, where are people buying on the buy side of the curve here that I can now target once we break those gaps? Well, a big area that I see is right here. Okay, there's a giant candle coming off of this, right? It's a giant candle coming off this, and it was also inside of a fair value gap at the same exact time. So I know when we sweep this liquidity with almost no displacement, and then we break these bullish gaps, that's going to be a very good target before we want to go up again. And keep in mind, I don't know what we're going to reverse here. I just know this is going to be a good target, and then once we hit here, I'll see what happens. So I know this is going to be a good target because there's such a good impulse off this fair value gap, so there must be a lot of stop losses down there. Now, I don't really know this low is going to hit until I see some sort of smart money reversal or major reversal or some order flow switch. And honestly, what I'm thinking is I guarantee you if the bias was bullish, this probably would not have been violated. So when it is violated, that would be one of your targets. Last but not least, equal lows would be another good draw on liquidity. So in this example here, we leave equal lows, and not only is it equal lows, okay, it also combines with a low inside of fair value gap. So we kind of make equal lows here. They're actually a tick off, so they're not perfect, but they're combined with a fair value gap as well, which makes it even more high probability. Now, there's no sign of smart money reversal here, in my opinion, so I don't really care about these now. But when I wake up in the morning and I see these are left, that's when I'm going to start looking for a giant order flow shift or a giant smart money reversal, and I'm going to have these for a draw on liquidity later. So up here, you can kind of see we got that kind of V-shaped kind of down movement. So at that point, I'm like, we're probably now in the sell model. But I don't know for sure yet, okay? I don't know for sure until I kind of see this. Once I see this reject in live time, I'm like, okay, this is definitely more bearish. It looks like we're on the sell side of the curve. Now this would be one of, notice how I didn't say the only target. This would be one of the targets on the way back down. There would obviously be other targets such as here, kind of look like relative equal lows, but you can kind of pick and choose the draw on liquidities you think are going to work best. Personally, I just use equal lows and equal highs, and then intermediate term lows and intermediate term highs, as I just explained. So there's equal lows on here. We end up going back down to them. And we actually ended up getting a long setup off them as well. You know, we came down here and we got an instantaneous kind of reaction here, and it was actually a long inversion to the upside again. And where does price end up targeting? Targets that high that rejects that fair value gap in order for us to go down. So if you just use these 4 drawn liquidities, you can find a lot of setups. Don't overcomplicate it. And I think these are probably the 4 best draws on liquidity you can use in the market. So yeah, if you have any questions, let me know in the comments, and I'll probably get back to you much easier in Discord. And yeah, that's gonna be it for the end of the video. If you guys want to practice working on this, just again, trust me when I say buy a few Apex accounts. They're very cheap right now, and again, they're just these fake $50,000 accounts where you can practice trading on them for like $30, and you're not actually, and you had the chance to gain real money, and you're not actually losing $2,000. You know, if you blow an account, you're only losing $30, not $2,000 like if you're in a live account. So especially this is good for a beginner. I would not recommend starting on a live account because you're just gonna blow all your money. So that's gonna be it for this video. Let me know if you guys have any questions, and thanks for watching. If you got to the end of the video, comment the word candle, and I'll see you in the next one. Peace.